Hello, this is Sophie Hammond and your Patton University online course instructor for this semester. We are finishing off course FIN610, Risk Analysis and Insurance, in Unit 8 today, beginning with the overview and introduction. Employers desire to take care of their employees, which can be achieved through fulfilling economic security needs. In recent years, employers have trended towards a flexible benefit plan that provides employees with the ability to choose their benefits. This has been accomplished through cafeteria-style plans that allow selection of flexible benefit credits, minimum levels of benefits, optional benefits, cash credits, and tax deferral. Another popular plan is the Flexible Spending Account, FSA, which allows employees to pay for specified benefits with before-tax dollars. Individual longevity risk plans also tend to be offered by employers. These plans characteristically involve payments by the company and/or the employee to a managed fund with distributions paid out to the employees or their beneficiaries, usually at retirement. Pension plans, profit-sharing plans, 401k plans, 403b and 457 plans, code plans, and the IRA and Roth IRA plans tend to be offered by employers. In addition to the above, we will also look at short and long-term disability plans. Short and long-term disability plans are typically offered by employers. Short-term disability plans provide sick leave plans, paid time off, and short-term disability income, whereas long-term disability plans provide these benefits along with rehabilitation benefits for a lengthier period of time. Employment-based plans provide additional incentives to employees to maintain employment with a given company. Comparative analysis of the options provided by each employer will provide both the employer as well as the employee an opportunity to contrast benefits. There are 3 learning objectives. The first is to critique employment-based longevity plans. The second is to appraise group and individual-based health plans. And the third is to evaluate various aspects of disability, long-term care, and supplementary insurance. We are going to begin today with Objective 1, Critique Employment-Based Longevity Plans. Starting with the first reading, The Nature of Qualified Pension Plans. A retirement plan may be qualified or non-qualified. The distinction is important to both the employer and employee because qualification produces a plan with a favorable tax status. In a qualified plan, employer contributions to an employee's pension during the employee's working years are deductible as a business expense but are not taxable income to the employee until they are received as benefits. Investment earnings on funds held by the trustee for the plan are not subject to income taxes as they are earned. Most non-qualified plans do not allow employer funding contributions to be deducted as a business expense unless they are classified as compensation to the employee, in which case they become taxable income for the employee. Investment earnings on these non-qualified accumulated pension funds are also subject to taxation. Retirement benefits from a non-qualified plan are a deductible business expense when they are paid to the employee, if not previously classified as compensation. Most non-qualified plans are for executives and designed to benefit only a small number of highly paid executives. ERISA requirements for qualified pension plans. To be qualified, a plan must fulfill various requirements. These requirements prevent those in control of the organization from using the plan primarily for their own benefit. The following requirements are enforced by the United States Internal Revenue Service, the United States Department of Labor, and the Pension Benefit Guaranty Corporation, PBGC. The plan must be legally binding in writing and communicated clearly to all employees. The plan must be for the exclusive benefit of the employees or their beneficiaries. The principal or income of the pension plan cannot be diverted to any other purpose unless the assets exceed those required to cover accrued pension benefits. The plan must benefit a broad class of employees and not discriminate in favor of highly compensated employees. The plan must be designed to be permanent and have continuing contributions. And lastly, the plan must comply with the Employee Retirement Income Security Act and subsequent federal laws. the Employee Retirement Income Security Act, ERISA, of 1974, and the subsequent amendments and laws, in particular the Tax Reform Act of 1986, TRA 86, are federal laws that regulate the design, funding, and communication aspects of private qualified retirement plans. The most recent amendments include the Economic Growth and Tax Relief Reconciliation Act, EGTRRA, of 2001, and the Pension Protection Act of 2006. In practice, the term ERISA is used to refer to the 1974 Act and all subsequent amendments and related laws. The purpose of ERISA is twofold: to protect the benefits of plan participants and to prevent discrimination in favor of highly compensated employees, that is, those who control the organization. Within the guidelines and standards established by ERISA, the subsequent federal laws, the employer must make some choices regarding the design of qualified retirement plan. The main items covered by ERISA and subsequent laws and amendments are the following: employee rights, reporting and disclosure rules, participation coverage, vesting, funding, fiduciary responsibilities, amounts contributed or withdrawn, non-discrimination, and tax penalties. ERISA and all subsequent laws provide significant protection to plan participants. Over time, however, the nature of the workforce changed from stable and permanent positions to mobile and transient positions, and it appeared to the ERISA failed to address portability issues when employees changed jobs. ERISA and subsequent laws are also considered to have administrative difficulties and to be a burden on employers. While the percentage of the working population covered is still unchanged since 1974, the number of defined benefit plans has dropped significantly, from a high of 175,000 plans in 1983, and more employees are now covered under defined contribution plans. ERISA has a safety valve for defined benefit plans with the insurance policy provided by the PBGC. Plans such as 401ks do not have such a safety valve. Information on how to protect your pensions is available from the Department of Labor and is featured in the box 10 Warning Signs that Pension Contributions Are Being Misused in Chapter 20, Employment-Based Risk Management, General. In 2001, EGTRRA addressed some of ERISA's shortfalls, and the 2006 Pension Protection Act provided some permanency to some of the EGTRRA laws. The new law offers employees that sponsor plans more flexibility in plan funding and incentives by allowing greater tax deductions. The major benefit of EGTRRA are the increases in retirement savings limits and mandates of faster participant vesting in employers matching contributions to 401k plans. These changes have become permanent with the adoption of the Pension Protection Act in 2006. Also, all employers' contributions are now subject to faster vesting requirements. The new laws provide greater portability, increased flexibility in plan funding and design, and administrative simplification. The EGTRRA 10-year sunset provision was eliminated with the 2006 Act. Eligibility and coverage requirements. A pension plan must establish eligibility criteria for determining who is covered. Most plans exclude certain classes of employees. For example, part-time or seasonal employees may not be covered. Separate plans may be set up for those paid on an hourly basis. Excluding certain classes of employees is allowed, providing the plan does not discriminate in favor of highly compensated employees, meets minimum eligibility requirements, and passes the tests noted below. Under ERISA, the minimum eligibility requirements are the attainment of age 21 and 1 year of service. A year of service is defined as working at least 1,000 hours within a calendar year. This is partly to reduce costs of enrolling employees who cease employment shortly after being hired, and partly because most younger employees attach a low value to benefits they will receive many years in the future. The Age Discrimination in Employment Act eliminates all maximum age limits for eligibility. Even when an employee is hired at an advanced age, such as 71, The employee must be eligible for the pension plan within the first year of service if the plan is offered to other younger hires in the same job. In addition to eligibility rules, ERISA has coverage requirements that are designed to improve participation by non-highly compensated employees. All employees of businesses with related ownership, called a controlled group, are treated for coverage requirements as if they were employees of one plan. Retirement age limits. To make a reasonable estimate of the cost of some retirement plans, mainly defined benefit plans, it is necessary to establish a retirement age for plan participants. For other types of plans, mainly defined contribution plans, setting a retirement age clarifies the age at which no additional employer contributions will be made to the employee's plan. The normal retirement age is the age at which full retirement benefits become available to retirees. Most private retirement plans specify age 65 as the normal retirement age. Early retirement may be allowed, but that option must be specified in the pension plan description. Usually, early retirement permanently reduces the benefit amount. For example, an early retirement provision may allow the participant to retire as early as age 55 if he or she also has at least 30 years of service with the employer. The pension benefit amount, however, would be reduced to take into account the shorter time available for fund accumulation and the likely longer period that benefits will be paid out. Early retirement plans used to be very appealing both to long-timers and to employees who saw replenishment of the workforce. In 2001, companies such as Procter & Gamble, Tribune Company, and Lucent Technologies used early retirement as an alternative to layoffs. Since the decline of old-fashioned defined benefit pensions, employees have less incentive to take early retirement. With defined contribution plans, employees continue to receive the employer's contribution or defer their compensation to a 401k plan as long as they work. The benefits are not frozen at a certain point, as in the traditional defined benefit plans. Mandatory requirement is considered age discrimination, except for the executives of high policy-making positions. Thus, a plan must allow for late requirement. Deferral of requirement beyond the normal retirement age does not interfere with the accumulation of benefits. That is, working beyond the normal requirement age may produce a pension benefit greater than would have been received at normal retirement age. However, a plan can set some limits on total benefits, or on total years of plan participation. These limits help control employer costs. Although the reading continues, we are now moving into Objective 2, to appraise group and individual-based health plans. Starting with the first reading, Group Health Insurance, an overview. Group health insurance, an overview. Today, health insurance is very different from what it was 2 or 3 decades ago. Most of us do not pay providers of healthcare directly and submit an insurance form for reimbursement. In addition, most of us do not have complete freedom in choosing our physicians, but must select from a list of in-network providers. The days of seeing any doctor or being reimbursed for any procedure the doctor orders are gone. We live in an era of receiving healthcare under managed care, controlled access to doctors, procedures, and medicines. While limited access is the disadvantage of the managed care system, there are many advantages. The most important is cost containment through efficiency. Another advantage is that most patients no longer have to deal with paperwork. Insureds simply make a co-payment to the healthcare provider, and the remaining reimbursements are done behind the scenes. Additional advantages include preventative care and higher standards for quality care. Costs are no longer controlled because the underlying issues that created medical cost inflation never disappeared. The main underlying factors are medical technology development, medical malpractice lawsuits, drug and medication development, the aging population, and the fact that a third party pays for the cost of obtaining medical services. People made the transition from the open choice of indemnity plans into the more controlled managed care plans such as PPOs, point of service, POS plans, and the various types of HMOs. But medical technology improvements, introduction of new medications, aging of the population, and medical malpractice continued in full swing. the cost control factors of managed care that eased medical cost inflation during the transition period are not as effective as they once were. Once most of the U.S. population enrolled in managed care plans, the cost-saving factors no longer surpassed medical cost inflation factors. The situation in the healthcare market is discussed in the box, "What is the trade-off between healthcare costs and benefits?" The old managed care plans are no longer viable and new ideas have emerged to supplement them. While the old systems are considered defined benefit health programs, the new ideas call for defined contribution health plans in which the consumer/employee receives a certain amount of money from the employer and then selects the desired healthcare components. Rather than employers negotiating with insurers or managed care organizations for the group health plans, consumers are encouraged to negotiate directly with providers because these new plans are considered consumer-driven health plans. In some form, these are the HSAs and the HRAs. Table 22.1, Spectrum of Health Plans, describes the managed healthcare plans prevalent in the marketplace today. Note, however, that the various health plans are no longer as distinct from the one they appear in the table. Since these plans were introduced, changes in healthcare regulations coupled with new laws concerned with patients' rights have eliminated some of the differences among the plans, and they now overlap greatly. Figure 22.2, Continuum of Health Plans, provides the 5 most prevalent health insurance plans on a continuum of choice and cost. There are other healthcare plans, such as exclusive physician organizations, EPOs, where doctors have created their own networks in response to the competitive environment, specifically hospital chains, medical centers, and insurance companies acquiring group practices. These networks do not provide access to out-of-network providers. On the other side of the spectrum, the subscribers of the indemnity plans could see any provider, pay for the services, and later apply for reimbursement. The premiums for HMOs were substantially lower than those for the indemnity plan. In most cases, the employer paid the full premium for an HMO and asked the employee to supplement the higher cost of the indemnity plan. Of these two extremes, who would select the HMO and who would select the indemnity plan? You answered correctly if you said that young and healthy employees most likely selected the HMOs. It turned out that there was an adverse selection against the indemnity plans, which saw the more mature and less healthy employees. The management of the indemnity plans began looking at the other extreme of the continuum for help in reducing costs. This is how managed care and traditional indemnity plans began. First, there were indemnity plans with large networks of limiting access to providers and reimbursing only for usual, customary, and reasonable (UCR) costs, that area based on studies of the appropriate cost for each medical procedure. But this was only the first step. The low copay that HMOs asked was very desirable. The newly formed Preferred Provider Organizations, PPOs, adopted the copay method and used managed care organizations to negotiate with doctors and all providers for large discounts. With some more than 50% of the usual, customary, and reasonable charges, the next step was to bring the gatekeeper, the primary care physician, which the HMOs used in most of their models, and is discussed later in this chapter, into the structure of the PPO. When a gatekeeper was introduced, the new plan was called a Point of Service, POS plan. This new plan is the PPO plus a gatekeeper, or the Individual Practice Association, IPA, HMO model discussed later in the chapter. The HMOs include various models: the model of one facility with doctors on staff, the staff model, the group model, the network model of doctors, and the Individual Practice Associations, IPAs, of many doctors in one practice. The doctors in an IPA could see HMO and non-HMO patients. In many cases, the POS and IPA are very similar from the point of view of the patients, except that when the POS is based on the Preferred Provider Organization rather than HMO, there is more access to out-of-network providers, but with penalties. These days, many IPAs allow some out-of-network access as well, especially in cases of emergencies. In both the PPO and IPA-based networks with a gatekeeper, POS, the provider specialists receive discounted fees for service, while the gatekeepers, primary care physicians, receive capitation, a set amount paid to each worker based on the number of subscribers in the plan. These are the areas where the distinctions among the plan become fuzzy. HMOs were forced to give more choices and services. Their subscribers, originally young, healthy employees, had become aging baby boomers who needed more quality care. Many states have passed bills requiring HMOs to loosen many of their restrictions. With all these changes came a price. HMOs became more expensive, with the best practices widely emulated. The offerings of all plans converged. The pendulum of choice versus cost has probably moved to be somewhere in the middle of the continuum shown in Figure 22.2, Continuum of Health Plans. For learning purposes, this chapter will regard HMOs as the plans with minimum access to out-of-work network providers. A comparison of the actual benefits under the various plans is available in the Employee Benefits Portfolio in Case 2 of Chapter 23, Cases in Holistic Risk Management. We will now give more detailed descriptions of the plans featured in Table 22.1, Spectrum of Health Plans, and Figure 22.2, Continuum of Health Plans. Following these descriptions, additional plans such as dental and long-term care plans will be discussed. Indemnity health plans, the traditional fee-for-service plans. The traditional method for providing group medical expense benefits has been paying healthcare providers a fee for services rendered. Healthcare providers include health professionals such as physicians and surgeons, as well as health facilities such as hospitals and outpatient surgery centers. Medical expense benefits may be provided on an indemnity service or valued basis. Indemnity benefits apply the principle of indemnity by providing payment for loss. The insured, the covered employee, or dependent would receive, for example, the actual costs incurred up to but not exceeding $300 per day for up to 90 days while confined in a hospital. Other dollar limits would be placed on benefits for other types of charges, such as those for ancillary charges, such as X-ray, laboratory, or drugs made by the hospital. There are 5 major classifications of traditional fee-for-service medical expense insurance. Number 1, hospital expense. 2, surgical expense. 3, medical expense. 4, major medical. And 5, comprehensive medical insurance. The first 3 types are called basic coverage and provide a limited set of services or reimburse a limited dollar amount. As the name suggests, major medical and comprehensive medical insurance provide coverage for large losses. Basic healthcare benefits. Basic healthcare benefits cover hospital, surgical, and medical expenses. These coverages are limited in terms of the types of services they provide as well as the dollar limits of protection. As Figure 22.3 Basic Medical Coverage shows, basic medical coverage generally provides first dollar coverage instead of protection against large losses. Disability insurance. Disability income insurance replaces lost income when the insured is unable to work. Income replacement is especially critical with disability because the individual faces not only the risk of reduced earnings, but also the risk of additional expenses resulting from medical or therapeutic services. In Chapter 18, Social Security, we discussed the Social Security Disability Program, which covers most employees in the United States. However, qualifying under the Social Security definition for disability is difficult. Workers' compensation is another source of disability insurance, but only for disability arising from employment-related injury or illness. See Chapter 16. Disability income insurance, available on a group or individual basis, closes the coverage gap that arises due to non-occupational injury or illness interpreting one's employment. Group disability insurance. Group disability income coverage provides economic security for employees who are unable to work due to illness or injury. An extended disability may result in greater economic hardship for the family than does the premature death of the employee. Employers, however, are less likely to provide group disability insurance than group life or medical expense insurance. Disability income may be provided on a short or long-term basis. The uninterrupted flow without gaps of coverage of group disability income is shown in Table 22.3. Employers used to offer only sick leave and long-term disability, leaving employees without coverage for a period of time. Consultants and employee benefits specialists urge employers to close the gap and provide seamless coverage as noted in Table 22.6, seamless coverage of group disability. Group short-term disability plans. The first step in short-term disability coverage is sick leave plans, also called salary continuation plans. With sick leave plans, employees accumulate leave, typically at a rate of 1 day per month of work, up to a maximum of 26 weeks. In the event of illness or disability, the employee uses sick leave and receives 100% income replacement beginning on the first day of illness or disability. Today, many employers do not offer sick leave separately from vacation. The combined time off is called paid time off, PTO. Under PTO, there is less incentive to abuse sick leave and more reward to employees who never use sick leave. PTO consolidates sick leave, personal leave, and vacation leave into a total number of personal days off each year. Short-term disability, STD, income replacement through insured plans generally includes all full-time employees after meeting some probationary period, such as 3 months. Unlike sick leave, these plans do not pay benefits until after an elimination period, typically from 1 to 7 days of absence from work due to disability. The employee may be required periodically to provide medical evidence of continuing disability. These plans pay for the duration stipulated in the employer's policy, usually ranging from 3 months to 2 years, although the majority pays for 1 year at most. Group short-term disability insurance plans do not provide full income replacement, but instead pay 65 to 75% of salary. This provision reduces moral hazard and encourages employees to return to work. The definition of disability determines when the employee is eligible for benefits. Short-term disability insurance policies generally define disability as the inability of the employee to perform any and every duty of the job. This liberal definition allows disabled workers to qualify for benefits relatively easy when compared with the definition of disability used by most group long-term disability insurance policies. Some STD policies require a more stringent definition of disability, especially those that provide coverage for a year or more. Under this definition, the employee will receive benefits only if unable to perform a job for which he or she is qualified by education and training. Generally, group short-term disability policies pay only for non-occupational disability, and workers' compensation benefits cover employees for short-term occupational income loss. Group long-term disability plans. The eligible criteria for group long-term disability LTD insurance are often different from those for short-term insured plans. Unlike short-term insured plans, which generally cover all full-time workers, long-term disability plans usually cover most salaried workers after they meet a probationary period lasting from 3 months to 1 year. Long-term disability plans also have an elimination period prior to payment of benefits, ranging from 3 to 6 months. The elimination period is often equivalent to the benefit period for the short-term disability plan. If the elimination period is longer than the period covered by short-term income replacement, the employee may have a gap in coverage. The definition of disability used for long-term plans is generally more restrictive than for short-term plans. Most contracts pay only if the employee is unable to engage in the material duties of the job. Under this definition, the employee receives benefits only if he or she cannot perform a job for which he or she is qualified by education, experience, and training. For example, a surgeon who can no longer perform surgery because of a hand injury may be able to manage the surgery room. This employee will not be eligible for LTD. Some STD and LTD group policies use a dual definition of disability. For example, benefits are payable while the own occupation definition applies for a relatively short period of time, perhaps 2 or 3 years. After that, long-term benefits are paid only if the employee is unable to engage in any reasonable occupation for which he or she is or can become qualified. Use of both definitions provides economic security to the employee and an economic incentive to find reasonable, gainful employment. The benefit period for LTD policies can vary greatly. Employees may be covered only for 5 or 10 years, and they may be covered until retirement age or for life. Typically, LTD plans pay no more than 60 to 70% of salary to disabled employees. In addition, a maximum dollar benefit amount may apply. Group disability benefits are usually coordinated with other disability income from Social Security or workers' compensation to ensure that the overall benefits are still below the level earned prior to disability. Employees may be able to obtain additional non-group disability insurance in the individual market to increase their total amount of protection, although seldom to the level of full income replacement. This ensures that the disabled person has an economic incentive to return to work. Most LTD contracts include a rehabilitation provision. This allows insureds to return to work on a trial basis for 1 or 2 years while partial long-term disability benefits continue. If disabled employees are unable to perform in the new job, long-term disability benefits are fully restored. By providing this safety net, insurers encourage disabled workers to attempt to return through rehabilitative employment. Insurers may also assist with training and rehabilitation costs because these can be far less when continuing benefit payments for those who do not return to work. LTD benefit amounts may also be affected by supplemental benefits made available to employees through payroll deductions. Cost of living adjustments can be added to prevent the erosion of purchasing power of the disability income benefit. Survivor's benefits can protect an employee's dependents after the death of the disabled employee. Group LTD contracts contain several important exclusions. Benefits are not paid unless the employee is under a physician's care. Benefits are not paid for self-inflicting injuries, and pre-existing condition clauses may restrict coverage. Generally, benefits are not paid if the employee is gainfully employed elsewhere. In the past long-term disability claims experience, both frequency and duration for hourly workers has been especially unfavorable relatively to salaried employees. This may be because hourly workers are more likely to be in jobs that are monotonous and produce lower satisfaction, factors that do not help keep employees at work or encourage them to return quickly. Disability claim frequency among hourly workers has risen, especially during periods of economic recession when job security is threatened. Hourly employees may choose to make a disability claim rather than to be laid off with temporary and minimal unemployment benefits. Because of unfavorable claims experience, employees and insurers are reluctant to provide hourly workers with long-term disability insurance. For salaried workers, too, there has been a shift in long-term disability claims experience in the last few years. The frequency and duration of claims by salaried employees and highly paid professionals, particularly physicians, have increased significantly. The rise in claims among physicians may be due in part to an increasingly litigious environment for practicing medicine and to healthcare financing reform initiatives that threaten the traditional practice of medicine, factors that can negatively affect physician job satisfaction. Among non-medical professionals, the increased incidence may be due to a more stressful business environment characterized by firm downsizing, especially among mid and upper management employees. Employers and insurers are paying attention to the increased incidence of claims among salaried employees and in some cases are limited the amount of benefits payable for long-term disability to reduce any potential moral hazard problems. Whether group disability benefits are taxable income to the employee depends on who pays the premiums. If the employer pays the premiums, the employee is taxed on the benefits. If the employee pays with after-tax income, the employee does not have to pay taxes on the benefits. If the employee pays with before-tax income, the employee pays taxes on the benefits in case of disability. Thus, many employers advise their employees to pay for this coverage themselves with after-tax income through payroll deductions. Traditionally, disability insurance has never been easy to sell. However, the need for such a product is always clearer during hard times. It is known that financial planners look at the lack of disability coverage as a gap in the complete coverage for a person. A downturn in the economy is actually helpful in pushing the sales of disability income policies. This reading continues. There is a unit quiz, flashcards, and some exercises for Unit 8. However, this concludes our brief read-through together of Unit 8, Employment-Based Risk Management Plans.